Okay, good evening, ladies and gentlemen. Welcome to the Global Finance Seminar held tonight. And the event is jointly organized by HKUST-NYU Stern Master of Science in Global Finance Program, South China Morning Post, and the CFA Institute. Before we start, please be reminded to turn off your cell phone or set it to vibration mode, please. Please also note that there is an evaluation form in your event folder. Any comments of the event today or the seminar series in general are welcomed and much appreciated. And we thank you for your consideration and help. Tonight it's our pleasure to present Professor Mark Seasholes, Academic Director of the Master of Science in Global Finance Program, and also Professor of Finance in HKUST, and as our keynote speaker tonight. In his presentation titled Individual Investors and Behavioral Finance in China, Professor Seasholes will examine behavior that now drives individual investment decisions in China. Our program tonight will commence with the welcome remarks by Dr. Wendy Guo, Head Education Asia Pacific Operations of the CFA Institute. After the keynote presentation, Ms. Angelina Kwan, Chief Operating Officer and Executive Managing Director of Reorient Financial Markets Limited, Mr. Alan Look, Head of Private Banking and Trust Services of Hang Seng Bank Limited, who is also one of our alumni, and also Mr. Richard Mack, Head of Advisory Services of, the name is Pictet? Okay, the Pictet Wealth Management Asia, and they will join Professor Mark Seasholes in a panel discussion. Mr. George Chen, Editor of Financial Services from the South China Morning Post, will serve as moderator. And before the end of the seminar, there will be a 10-minute Q&A session. Now, may I invite Dr. Wendy Guo to deliver the welcome remarks. Dr. Guo, please.
Thank you. To date, the financial industry is going through what could be termed as a crisis of confidence. There's a lack of trust, distrust in the financial system, distrust by the public. The CFA Institute mission is to lead the investment profession globally by promoting the highest standards of ethic, education, and professional excellency for the ultimate benefit of society. CFA Institute advocates for financial market integrity and investor protection. Both are essentials for a positive outcome and long-term economic stability. To help restore the trust in the financial industry, CFA Institute recently unveiled the integrity list, a list of 50 tangible steps that practitioners can apply in their firms. For example, requiring training on ethical decision-making for yourself and for your firm, placing the client's interests before your own, and recommending products with transparent payoffs, costs, and risks. And we are not working alone. Morningstar, who provides data on approximately 375,000 financial products in 27 countries, has requested management firms to be GIPS compliant in order to earn star ratings. GIPS is the global investment performance standards CFA Institute advocates for. A trusting industry, starts with trustful relationships. CFA Institute is proud to partner with regulators, practitioners, local CFA societies, media, as well as universities. To date, we are honored to partner with Hong Kong, HKUST-NYU Stern, and South China Morning Post to bring you this seminar. This is our first collaboration, and I can see many more to come. Okay. It's well known that China and its economic activities are of strong interest to the world's financial industry and global business. And China is also of particular interest to CFA Institute. Right now, there are over 30,000 candidates in China studying for the CFA program, the largest number of candidates in the region. And next year, in 2013, CFA Institute is going to launch a new global access scholarship program. Under this program, over 270 scholarships will be available to candidates based in China, further expanding our reach of ethics and trust in this emerging powerhouse. This seminar offers insight into investor behaviors in China and how it may impact the local stock markets and global investment decisions. Okay. What are the risks and opportunities ahead? I'll leave you to formulate your own answer. But there's one thing for sure, and that is it's time to engage, and it's time to collaborate, and it's time to develop and maintain trustful relationships, which in this complex industry are key to success. Okay. Now, before we turn to the program, and may I take this opportunity to mention that my colleague and Tom Robinson, Managing Director of Education for the industry for the CFA Institute, is also here tonight. If you have any questions about the CFA Institute and how we serve the industry, feel free to talk to us. Okay? Without further ado, so let's welcome Dr. Professor Seasholes to the podium.
Great. All right. Here we go. Thank you so much for coming. This is terrific. We have some of our current students from the Masters in Global Finance program here. And it's nice to have a program that is a collaboration with both the South China Morning Post and the CFA and CFA Institute. So this is terrific. I'm going to talk about investor behavior today. I'm going to talk about some of my research in specifically, and I'm going to talk about maybe investor behavior more generally, and then as a panel we'll get into any questions you have and broadly how investor behavior may affect people's wealth or markets. So let's just start with an example. Just imagine somebody in Hong Kong. I tried to pick a name. I Googled it and didn't find any matches, so hopefully this is a fictitious person who wants to buy a stock for savings purposes. They have some money. They don't know what they're doing, so they decide, okay, I'll buy one stock for starters. At the time, there was over 1,000 listed stocks in Hong Kong, and this person's trying to figure out which stock to buy. So Mr. Chan, notices adverts for HSBC, let's say along Queens Road here. He knows the bank has a very good reputation in Hong Kong. He knows the financial crisis by the end of 2010 or early 2010 is mostly past. The stock has gone up 50% in the last 6 months, which is all true. I checked the data on this. So, he goes out and he buys 10,000 shares at the price at the beginning of 2010 was $91.85. So you start thinking, what's wrong with this example? And this is how some people make decisions. And so what's odd about it, in this example, which is kind of representative, he hasn't put any thought into the future prospects of the stock. He's kind of thought about what stock does he know, looking at past performance. Maybe he knows some people who work there. He's comfortable with the company. There's also no consideration of diversification. And clearly, look, for someone who's buying their first stock, analyzing 1,000+ stocks is too much. But just because analyzing 1,000 stocks is too much doesn't make this method of picking stocks even close to right. So what's happened here is he's had a big problem in front of him, and he's narrowed it down into a very small problem, but it's kind of missed all of the point. He didn't think about HSBC. If I'm only going to buy one stock, how does that fit in with my portfolio? If I'm a banker, maybe he works at like a East Asia Bank or another one. Do I really want to be investing all my wealth in another bank? So I'm totally loaded up on the financial sector. There was nothing about that here. So I think when we think about behavioral finance, we're thinking about people making kind of decisions and how psychology might affect some of their decisions. Today, what we're going to do is just very briefly talk about why study behavioral finance. I'll talk about some of our data that we've been analyzing. I'll talk about some behaviors and biases. I can't talk about them all, but we can talk about more in the panel discussion, and some conclusions. One thing to note, again, I'm going to talk about our research, the current research, the most current, which is on Chinese individual investors. But you should understand that many of these behaviors have been seen in professionals. So, for instance, professional traders who come to laboratory setups and are part of economic tests, or academics who get hold of like CBOT data and can look at what professional traders are doing in Chicago, or college students who run through laboratory experiments in Carnegie Mellon. Much of this behavior is documented over a range of cultures and types of people and investors. So we'll talk about the broad implications. Please don't get too focused on this only applies to, small investors in outer Mongolia or inner Mongolia. Okay, so background. I think it's just before we start, you would want to just think, why even bother looking at behavioral finance? There's two main reasons to do so. The first is about investor wealth and welfare. If you think people are making mistakes in choosing their portfolio, as a regulator, you might want to put rules in place or systems to help them avoid those mistakes. As a financial advisor, someone who, as we just heard from the CFA, puts their client's interest first, you'll want to help them overcome the mistakes. Now, if you're only interested in churning your client's account, this isn't for you. But if you're a financial advisor who really cares about your client, I would think you would want to invest some of your resources into learning about the possible investments and about the possible mistakes people make when they come to you. Now, on the slightly darker side, but on the free market side, we care about people's mistakes in terms of, are the prices we see in the market actually representative of the true price? Are they getting distorted by behavior? A hedge fund could ask, can I trade against sentiment or investment behavior to profit? Now, some people think, okay, ethical, not ethical. There's a good argument to be made that trading against such behavior makes prices better for everyone. So I'll stay out of the normative part of this, but certainly institutions and hedge funds care about this research because it can offer trading opportunities. Okay, so moving forward, what are we doing right now? What are we looking at? We have some brokerage records, some very extensive ones from China. It's from a single firm, but the firm is quite national. It has 42 branch offices throughout China, and they're located in 17 different regions. So we're not just talking about the rich coastal areas. Currently, we have about 10 years of data, and about 500,000 people have traded at some point over those 10 years. What we want to do is we want to look at an individual by individual, and try to make comments about what the average individual or median individual might be doing. And we know that in China, there are cases of people going back to their village, getting lots of passports, signing up for accounts. And what's nice about the brokerage data is they know that this one person has access to 10 accounts. So we've gotten the data already kind of aggregated for us at what's called a fund account level. So if we see trades from 10 accounts, we know they're actually controlled by one person. This is an advantage over using exchange data because the exchange doesn't know that. They only see the account number. The advantage with exchange data is it comes from many brokerage offices, not just this one. There are clearly confidentiality issues. I've worked with a number of data sets, including State Street, and they can all be solved. For instance, when you work closely with a client, they can hide the identities of the people. You tell them how to code what information we need. As long as they put the same, they can randomly assign each person in the data set a random number. As long as they trace that through and they keep the key, we can all be fine.